Okay, in this video, I continue with the how to identify the applicable ratio. So we've looked at two categories. Now this is number 3. For number 3, if you see if they ask you a direct question, comment on profitability, or they can say comment on operating efficiency. Right, profitability or operating efficiency. It is very critical for you to know the ratios that you may use there. Now, the first one is going to be operating profit on sales, and then you've got operating expenses on sales. Right, and then you can have net profit on sales. Okay, I'm mainly going to focus on the first two, that is your operating profit on sales and your operating expenses on sales. So ideally, operating profit must go up. That's the best scenario that you can have. And then your operating expenses, we normally would want them to go down. So if operating profit goes up and operating expenses go up, remember these are all percentages, right? These are percentages. So if your operating profit goes up and your operating expenses go down, this is the ideal scenario. But we know that this is very rare, because in most economies, especially in Africa or in sub-Saharan Africa, you'll discover that there is inflation. So there's a general increase in price levels. So you'd normally expect that that expenses go up instead of going down. But the ideal scenario would actually be to have your profit going up and your expenses going down. And then, because we know that they're always going, both of them are going up, it is advisable, or the best scenario will be that if they're both increasing, the magnitude of the increase between operating profit and operating expense must be different. Operating profit must increase more than operating expenses, which means in this case, you end up with a profit. In this case, you also end up with a profit. Let's say they are all going down. If they're all going down, then it means operating profit must go down by a small margin, but operating expenses must go down by a bigger margin. If you have that scenario, you still end up with a profit. So what am I saying here? I'm saying naturally, what you would want to be the ideal scenario is that your income, which is your profit, goes up and your expenses go down, then you make a profit. But if both of them are going to increase, then you would want your income, which is your profit, to increase more than your expenses. You still make a profit. But if you have a problem in the economy and both of them are decreasing, it means income must decrease with a lesser percentage than the decrease in your expenses. So the best scenario would actually be to get number 1. But if you can't, if you have the other two, you will look at what I've shown here. So we are saying, for us to say a business is operating efficiently, the business must have an ability to manage expenses. Meaning to say, part of this identification here, they can actually say to you, management of expenses. I want you to avoid confusion in that. When we were looking at liquidity, we said management of cash, but here I'm saying management of expenses, right? So a business can only operate efficiently to make a profit when they have an ability to manage their expenses, which means expenses must decrease. If expenses increase, they must increase with the percentage which is below the increase in income. If both expenses and income are decreasing, then expenses must decrease more. That is the only way for you to end up with profitability. So your management of expenses is the one that leads to profitability, because you can only make money and be profitable if you've got an ability to manage your expenses.